Hey everybody, this is Bo Yoder. I've been getting some feedback, some emails asking about really one of the fundamental tools of any trading strategy, which is position sizing. Something that gets overlooked a lot. You know, there's this sort of fantasy that traders are hanging out on the couch in their PJs, pushing some buttons and making tens of thousands of dollars. And while the lifestyle benefits of trading are absurd, there is an engine underlying all of this, and that engine really is very scientific, very mathematically based. It's not particularly sexy, but you gotta have it. Otherwise, you're going to introduce a lot of luck into your trading. And that's exactly what we try to do on each and every tool that we have, is to remove luck. All right. So think about it. If you just go into the market and kind of jump in randomly, you know, you're going to be lucky or unlucky. Every tool that we use within the 3D Apex trading methodology or within any profitable trading strategy is about removing luck and inserting objective measurements. Okay, so now let's take an example that's a classic. So let's say that you take a trade in Google and you take a trade in Alcoa aluminum. All right. Same pattern, same reason for taking the trade. That's really not the point here. I want to talk about position sizing. So let's say the trade in Google is going to have a $25 stop. And the trade in Alcoa aluminum is going to have a 25-cent stop. All right. Now, what a lot of people do, especially in the sort of the beginning period of their trading experience, what I call the ignorance phase. Remember, ignorance is very different from stupidity. Ignorance just means that there's information out there that you aren't privy to yet. You don't know yet how to do things correctly. Stupidity implies that you couldn't ever learn it. So during that ignorance phase, you know, people tend to trade round lot sizes. So they'll trade, let's say, 500 shares. All right. Well, obviously, 500 shares times 25 bucks a share is a risk of $12,500. Now, I'm obviously exaggerating this. I want to make this point abundantly clear to you. Let's take an example over here. Same thing. They'll just randomly assign 500 shares because it sounds or feels right, even worse. And on the Alcoa aluminum trade, they are risking $125. So you can instantly see here why this position sizing is so important, right? You take two trades, they feel the same, they look the same, they have the same pattern, you use the same number of shares, but you're, you know, risking half a car over here, and you're risking, I don't know, a nice steak dinner over here. So that introduces luck, because now the random distribution of results is going to ensure, along with our good friend Murphy from Murphy's Law, that this ends up being a loser and this ends up being a winner. Okay? So obviously, if you won $125,000 and you lost $12,500, you'd be in the hole $12,375. All right, so let's just remember that, and let's go on to the next level. So the first thing you need to do is figure out how much risk you want to take on any given trade. So let's assume, just to make this real simple, and because the round numbers are often easier to deal with, that we have $100,000 in capital. Let me just fill that out. Okay, so let's then also assume that you're taking our advice, which is very strongly put out there from years of experience, that you risk no more than 2% on any given trade. So the math on that's super simple. 2% times 100 grand is 2 grand. Okay, so your maximum acceptable risk on any given trade should be no more than $2,000. So now the algorithm to figure this out becomes real simple. You take the amount of dollars, the amount of currency that you have in your account. Of course, this could be pounds, euros, any other currency. It's the math is the same, and then you divide it by the size of your stop. Okay, and it works real easy in stock market because it's quoted in terms of dollars. I'll show you another example on that in just a moment. All right, so super simple. How many shares do we take for this trade? $2,000 in risk divided by $25 in risk per unit, basically per share, gives you, well, let's change that state, 80. That's not really, yeah, there you go, 80 shares, right? So if you took that trade on 80 shares and you made $25 in profit, which is essentially the same amount of risk that you took, that would be a double your money trade. For every $2,000 in risk you took, you'd make $2,000 in profit. Great trade, okay? So that's the basic math. Now look at what happens over here if we run that same algorithm on this potential trade in Alcoa. Same exact thing. We're going to risk $2,000, and we're going to divide that by the risk per share. We'll talk again about risk per contract in a minute, of 25 cents. So on this trade, you're going to take 8,000 shares. So see the difference? This takes the luck of the draw out of this situation, because now, let's say we have the exact same Murphy's Law situation. We have 80 shares and we lose $25 a share, so that's a negative $2,000. With our 8,000 shares in Alcoa, we risked 25 cents, and let's profit by 25 cents. So 8,000 times 0.25 is $2,000. Those two trades net out, and you end up with a big fat zero. All right, and this is crucially important because there are really only two ways to profit in the market. You can have a high risk to reward ratio, which usually means you have a very low win rate. All right, so let me go ahead and just write that out so it's real obvious for everybody. So with a high risk to reward or reward risk ratio, you usually have low accuracy. If you have a low risk reward ratio, you tend to have high accuracy. And this is just a very broad generalization. We can kind of cheat some of those rules by using the filters that are available within 3D Apex, and I'm going to talk about that in just a second. Actually, you know what? Let's talk about that now. Okay, so from a purely statistical standpoint, let's say that you have a setup that you are researching, and you find out that if you take that setup, 35% of the time, it goes 3-to-1. Okay? Same setup, same mode of entry, same way to find it. Let's say that setup will go 75% of the time to 1.5-to-1. Actually, let's make that a little lower. Let's just do 1-to-1. Makes the math easier. Okay? So if you took 100 trades, obviously you'd have 75 winners and 25 losers. So your gross on that would be $75, right? Because every time it goes, you make a dollar. And you would lose 25% of the time. So you'd have minus 25 over here. Obviously, the net on that would be 50 in profit for every trade. That's a profitable trading strategy. Okay? Let's go over here and look at the 35%. So on 100 minus 35, whoops. So 65 trades are going to lose. You're going to lose a dollar. And then 35 are going to go up $3. So you lose $65, you make $105. Your net on that is going to be $40. Okay? So with the high accuracy, low risk reward trading scenario, given the same exact setup, the same exact market opportunity, using the mathematics of statistics based on your research, you can actually determine that you are going to make more money over time by just capturing the 1-to-1 profit, which is very accurate, versus capturing the lower probability but larger profit. Okay? Now, you may need to pause this video and kind of go back and look at that once more, but this is where people get lost in emotion. All right? It's fun, it's sexy, it's exciting to take big profits. After all, if you were going to risk 2% on your trades, with this 35% model, you're going to make $6,000 every time that you get a winning trade. And that's going to be very exciting. But it's not as profitable. It is profitable, right? So you could technically run this trading program and make money. But there's more money to be made if you optimize that trading strategy. Okay, so that's the base statistical model. Now let's take this another level. You can't change the underlying value of a particular trade. That's immutable. That's the way it is. But what if you had a way to filter out some of the trades that were lower probability? If you had an objective way to measure the market's cyclicality and the power inherent in the market. Okay, so now you're not changing the underlying methodology here, or that's an incorrect word, the pattern that you're trading. You're not changing the pattern, but you're changing the way that you interact with the pattern. Okay, so there's still 100 instances of the pattern. 75% of them work, and 25% don't. But you now, because of your superior analysis methodology, are able to avoid 5% of those. All right, so now your accuracy rate is going to jump. You're going to have actually let's do that out. Let's do that out explicitly here below. Okay, so of the 75 winners that are out there and the 25 losers, you are going to, through your superior analysis, you're going to avoid 5 of those losers. Okay, so now you only lose 20%. You're still making the 75. Nothing's changed there, right? You can't make the market do what you want. A profitable trade only has, whatever its inherent accuracy. But what we've just done is we've reduced our losses. So in this example, you're going to make 50 units of profit. In this example, you're going to make 55 units of profit. So that's an improvement of 10%, right? Oops, let's write that out. Again, this is I'm kind of leading you down the garden path here, and I really want you to understand how the structure works. See how impactful avoiding losses can be? You haven't increased the number of winners out of every 100 trades. You can't do that. That's just, the base underlying statistics of a particular pattern. But you can choose to not interact with that pattern from time to time because of your filtration. And the 3D Apex trading methodology has a number of tools that are very focused on that specific aspect of loss avoidance. So it could be said then that your win rate has actually gone up, right? So if you have 100 trades and you're only losing 20 of them instead of 25, you've actually increased your overall accuracy on the trades that you've taken. So the way to do that would be 75 plus 20 is 95. So it would be 20 divided by 95. You're now only losing 21% of the time instead of 25% of the time. You just increased your accuracy to 79% wins. Boom, instant change, massive increase in profitability, massive decrease in fear and loss. One of the most ego-satisfying things and capital-satisfying things possible is to look at a pattern, see that it's technically perfect, see the filters telling you that there are hidden flaws in that pattern, walk away from that pattern, and then watch it fail. Obviously, you don't make or lose any money on that trade, but you've just outperformed compared to everybody else who took that pattern. They took it, they lost money, they're frustrated, they can't figure out why that trade failed, and that tends to bring those negative emotions through to the next trade. All right, so that right there is probably the most important key in the mathematics of trading once you get through the basic concept of diversifying your risk so that you're really never risking more than that set 2%. All right, so now I did mention there's one caveat to this simple algorithm of dollars you wish to risk divided by the amount of dollars on one particular lot, and that shows up in the futures market, in the commodities market, where you have a set contract size. Now, for most of you, the currency markets, this isn't going to be a problem because they offer mini and micro lots. But in the old traditional sense, and if you're trading the futures contracts on currencies, you're stuck with a specific position size. So let's go ahead and just scroll up here a little bit so we have a little more room, and we'll go through that. So let's take a traditional intraday trade in the ES. Okay, now the ES is the S&P 500 index proxy, and it has a value per point of $50. Okay, so you really can't get any smaller than that, right? So your base, if you only took one contract, it's going to cost you $50. Now, if you've got $100,000 in your account, that makes it real simple. If you're trying to risk $2,000, then basically it goes like this. All right, so if it's $50 a point on one contract, you have to then multiply that by the number of points. So there's one extra step here. So if we have a 5-point stop, then it would be 5 times 50. So on one contract, the risk on that trade would be $250. Then you take that and you do your multiplication, or your divisions, excuse me. So we got equals 2,000, that's the money you wish to risk, divided by the minimum amount of loss on one unit, one contract in this case. So that means you would take 8 contracts. Again, you may need to pause and go back. So basically what you're doing is you're figuring out the minimum amount you could lose if you took the minimum contract size. And again, this is real simple in stocks because your minimum contract size is one share. So that makes it simple. But if you're going to use this in this concept in the futures market, you just need to get one more step, which is whatever your point value is, and that changes depending on what contract you're trading, times the number of points, and then that gives you your number that you can then do your position sizing algorithm on. Now, if you are starting with a small account, some markets are actually priced out of your reach. And that's just something that you have to acknowledge and know that those markets really aren't for you until you increase your capital. And this is one of the very powerful reasons why we decided at the beginning of our 3D Apex launch, when we started to bring forth this methodology to the public, to use the Forex market as our teaching and training tool. Forex market, number one, is open 24 hours a day throughout the week, closes for a little bit over the weekend. But that makes it accessible to people really in any time frame, whether they're working a full-time job in the US, whether they're over in Europe, whether they're in Australia. There's always opportunity flow for you to practice and learn on. And second is that the granularity of that market is very high. You can actually, the base minimum on that market is, for most brokers, 1,000 units, basically $1,000 or euros. So the risk on that is a penny a pip. So that makes the position sizing algorithm real simple. So now that's the base math, that's the concept behind it. We have a tool that we've built which automates this process and makes it simple. So let me go ahead and bring that up, and I'll just walk you through that real quick. Okay, here we are on the compounding and risk management spreadsheet. And you can see up here in the top, you've got basically just a simple plug and play a way to run that algorithm. So what do you want to risk? Well, we're going to do a 2% risk, as we talked about before. We got a $100,000 account. Again, you can put in whatever number is appropriate for you. Now, your blowout risk in pips, in this case, this is really focused on the currency market. And this also is focused on US dollar quoted currency, so the euro versus the dollar, the Aussie versus the dollar. We're working on a second spreadsheet that will allow you to use some of the other currencies as well, so keep an eye out for that. But anyway, you've got the blowout risk in pips. So let's say it's a 22 pip risk. In order to risk $2,000, you need to take 9.09 standard lots. Okay, so a standard lot in the currency market is 100,000 of the base currency. So then the first decimal would be the equivalent of a mini lot for people, which would be a 10,000 of the base currency. And then the second decimal place here in this spreadsheet is the micro lots. So you could express this as 9.09 standard lots, 90.9 mini lots, or 909 micro lots. It's all the same thing. It's just changing the decimal place. And so that's how you do it. Real simple, real easy. And then for those who are interested in trading as a liquidity provider in a more aggressive manner, which I call the ladder strategy, talk about that in some of the other training videos, then there's a secondary situation down here. So same thing. You want to risk 2%. In this case, let's say I got 150 grand there. Let's do 100 grand. And let's say we use the same 22 pips. Same risk in dollars. The blowout risk is calculated to be 67, and then this tells you what each ladder rung. You should have just about 3 standard lots in your rungs. So those are the tools that we've designed, which are make it fast and easy. I'm going to go ahead and put a link below this video. If you want to click on that and just put in your email, be happy to send this out for you, and then you could have this as part of your trading. So as always, thanks for listening. My name's Bo Yoder. Again, we really focused here on some of the math surrounding what I would call de-lucking, or reducing risk, distributing risk. Again, trying to take the luck out of trades so that you can literally have a 200 pip risk and a 2 pip risk going at the same time in 2 different markets, and the monetary value or the monetary gain there is going to be exactly balanced. So if you have a big winner and you take a loser, you end up net profitable. You've taken the luck out of that play.